Firstly, hello everybody. My name is Robert Lallo. I'm an advising partner with Sandringham Financial Partners, who are a national firm of independent financial advisors. Therefore, we're not tied or restricted to a single company or indeed a panel of companies. And of course, we are authorised and regulated by the Financial Conduct Authority. Next slide. Yeah. What you can see in front of you there are the main areas in which I can help and advise my clients with, and also details of our FCA number. Next slide. Okay, I just wanted to run through some legal information. Obviously, the contents of the presentation just represents my views, so it should not be viewed or construed as financial advice. And of course, all information is based on our current understanding of current law and practice, which of course could change or indeed may be subject to change in the future. And needless to say, any investments that are made can go up as well as down. So we'll get all the legal stuff out of the way. We'll crack on. So next slide, please. Okay, pensions for business owners. So I'm here to talk about pensions, obviously for business owners. I mean, I could have easily called this pensions for all, given the benefits which are just about applicable to just about everyone. However, I want to concentrate on business owners, whether they be sole traders or limited companies, and the advantages of using pensions to reduce taxable profits and ultimately, of course, boost your retirement income. Next slide. Okay, so how do we fund retirement? Well, okay, there's several sources of income, and I think you should view pensions as sort of part of the jigsaw. There are state and guaranteed pensions, which I'll come to later. There are ISAs and any other investments you may hold. Of course, cash. So if you have cash sitting on deposit, which you've saved, and it's obviously there to boost the retirement income as well. Ongoing dividends from your company doesn't apply to everybody. However, they are used to boost retirement income if the company is still running. And of course, rental property, you may decide or indeed already have a portfolio or indeed just one rental property that produces an income. And of course, last but not least, pension funds. Next slide, please. So why pensions for business owners? Why are pensions so advantageous? I think the most important thing to remember is they are, without a shadow of doubt, probably the best way to save money over the medium to long term. And that's simply because you're getting free money from the government. And that free money is in the form of tax relief. Now, the amount of tax relief an individual receives is purely dependent really on the rate of tax they pay. So basic rate taxpayers will receive tax relief at 20%. So for every pound that a basic rate taxpayer pays into a pension, the government will add 25 pence. And of course, it's even more attractive for higher rate taxpayers and additional rate taxpayers. So let's talk about contributions and the limits of contributions, because yes, pretty much everybody can have a pension, even a small child can have a pension, but personal contributions are restricted, and they're restricted to 100% of an individual's net relevant earnings. Now, this is particularly important for limited company directors, which traditionally or typically pay themselves in the form of a modest pay-as-you-earn salary, mainly to qualify for a pension, state pension that is, and but the bulk of their income will be provided by dividends. Now, dividends do not count as net relevant earnings, and I get this question asked to me quite often, where I've got a client who are company directors or new, more to the point, potential new clients who are paying themselves just under the higher rate tax bracket, thinking that they can put that money in personally into pensions. Well, that's not the case. They're restricted to 100% of their salary. So how can we get around that, particularly for limited company owners? Well, the good news is if you run a limited company, the company hopefully will make profit. And those profits usually, well, once the tax has been paid on them, of course, they become retained profits. So a company is not, or more to the point, an employer contribution is not restricted to the annual allowance, which is £40,000. So that's the most an individual can pay into a pension in a particular tax year, or £3,600 if greater. So let's say you run, I don't know, you have a very small part-time job where you earn about £3,200. You can still pay £3,600. So that's a good thing. That was introduced 6 or 7 years ago, which really allowed so many more people to be able to contribute to pensions. But anyway, going back onto employer contributions. So if your company is in a good financial state and you want to take advantage of the pension allowance, to, in other words, boost your retirement income, then the company could make contributions of up to £40,000 on your behalf. And normally, 9 times out of 10, they would be, HMRC would not have a problem. It's very rarely tested for your company to make that level of contribution, as long as the contribution is wholly and exclusively for the benefit of the business. So I've been doing this job for over 30 years now, and I've never had HMRC contest an employer contribution. So the likelihood is it shouldn't be a problem. However, I can't guarantee that it wouldn't be. But anyway, so the big plus for limited company directors or owner companies is that, look, if you're paying yourself £10,000 a year and you're making extremely good profits, utilize those profits, because it's a wonderful way to get money out of the company from a corporate environment to your personal environment in the form of your pension. Now, which is a good thing, but one of the biggest advantages, of course, is because the company is making an employer contribution on your behalf, it's tax deductible. So it's basically an allowable expense to the business, which of course will reduce corporation tax. So let's say you're having a particularly good year, and you are or more than what the company is likely to be paying a quite large corporation tax bill. Make that pension contribution, because that will reduce profits, particularly if the money is what I call lazy money. So it's not earmarked for any form of expansion or anything like that. It's literally money that is likely to sit there for a number of years. So a very, very good way of getting money out of the limited company into the pension, saving tax from a corporation tax point of view. And of course, let's not forget that a pension fund is virtually tax-free. So it's a wonderful way of moving the money, getting the tax break, and putting it into a tax-privileged environment. Extremely beneficial and a brilliant way of actually saving money, but also, most importantly, boosting retirement income and, of course, saving tax to boot. Now, what's the situation if you're maybe sitting on a huge amount of retained profits, which really aren't doing anything, and you haven't used up your previous annual allowances? In other words, that's the amount you can pay into pensions each year. You're able to actually carry forward some pension contributions over the last 3 tax years. Therefore, technically, as long as you fully fund this tax year, so if we fully fund this tax year at £40,000, we're able to go back 3 further years. So in actual fact, you could actually pay in, the company could actually pay in £160,000. And that's just under a £32,000 reduction in corporation tax. However, that, by the way, is not guaranteed. It really depends on the local inspector of taxes. There certainly would be a tax break, of course, but whether you get it to that extent remains to be seen. Next slide, please. Okay, another great way of using pension funds for business owners is to purchase commercial property. And I've put there in a lot of cases your own business premises. Of course, you know, if you're renting your business premises, and let's say, which does happen quite often, the landlord is selling those premises. If you're in a fortunate enough position to be able to possibly buy those premises using the pension fund, it's an absolutely brilliant way of using pension money. Simply because we look at those bullets there, rents can be reinvested into the SIP. So effectively, your own limited company is paying the rent to your own pension fund. There's no income tax to pay on the rents received, of course. And if you're paying the rent, it is still a taxable deductible business expense. Which is great, and no capital gains tax when you sell it, and proceeds of the sale when selling commercial property in a SIP go into your pension. And also don't forget that a pension fund is, as I mentioned earlier, a privileged tax wrapper, which of course means that in the vast majority of cases is sheltered from any inheritance tax. So a lot of tax breaks to be had there. So if you're in a position where you feel like you are, would like to purchase your own business premises rather than paying rent every month, then it's a super way of utilizing again your pension fund. I mentioned earlier tax-efficient growth of funds invested. And also, when we think about a pension, it's really all it is a long-term savings plan with the added advantage of government tax relief. Now, a lot of people say to me, when we talk about pensions, yes, okay, it's a pretty unglamorous subject, and some people love pensions and some people hate them, but you can't deny the fact that they are extremely tax efficient. And when we think about that, we're saving into a pension, we're receiving tax relief on the contributions going in. Okay, when we draw the pension from the age of 55, of course, if it's a private pension or a SIP, which incidentally is changed to the age of 57 in 2028, we're only actually taxed on 75% of the fund because we're allowed to have 25% tax-free as a lump sum. So when we think about that, that again is extremely tax advantageous, really, because you're getting tax relief going in, it's growing a tax privileged environment, and then when you draw it, you're only actually taxed on 75%. So you could be a high rate taxpayer throughout your working life, benefit from high rate tax relief, and then become a basic rate taxpayer, dependent, of course, how you draw the pension. So you could actually control the amount of tax you pay in retirement. Not for everybody, to be fair, but for a number of people you can. But look, let's be honest, the most important thing about pensions is it's there to provide a retirement income. The tax savings are great, and hopefully long may they continue. But they are there to boost your retirement income. And when you add whatever you paid into a pension, and together with everything else that you may amass, as I said, it's part of the jigsaw. However, not everyone is fortunate enough to own other properties apart from their main residence, or indeed hold ISA portfolios or bonds, or it doesn't really matter, any other form of asset. The majority of people in the UK, their only asset apart from their property is their pension. So it's really, really important that it's used as best as it can be. And that really means paying into pensions as much as an individual can. Because don't forget, it's the early contributions that attract the most growth because they've been in that pot for a longer period of time. So I always say to all my clients, pay the most you can pay into a pension. Don't pay a modest amount if you know you can afford more. Pay the most you can pay in, because trust me, when you are 55, or indeed, it doesn't really matter, but that's the early stage you can draw on at the moment, you will not regret it because you funded in the early years at a good level. There's far too many people who earn good money, or indeed company directors who are sitting on, good retained profits and not utilising them, and it's a shame. But next slide, please. Okay, I spoke earlier about the different income streams in retirement, and of course, one income stream which I can't say is guaranteed, of course, but it really depends. But for most of us, we will receive a state pension of a certain amount. Now, that amount is purely based on how many national insurance, how many years national insurance contributions we've actually been paid into. Now, if you look at the current, the new state pension, because it did change in 2015, at the moment, the maximum an individual is likely to receive is £185.15 per week. And that qualification is based on 35 years of national insurance contributions. So if an individual has paid that 35 years, they will get, at the moment anyway, that amount. And of course, state pensions do increase. I won't get into the technicalities of the triple lock, but we do have some form of inflationary increase in pensions, not as favourable as what it was first promised, but anyway. And particularly with inflation now at 9–10%, we'll see what happens. But anyway, so 35 years will give you a full state pension. Anything between 10 and 34 years, you'll receive a proportion of the pension. And anything less than 10 years, you wouldn't be eligible usually for a state pension. Now, I get many clients who, let's say, moved abroad for a number of years, or looked after their children for a number of years. So as a consequence, there'd be gaps in their national insurance record. Well, they can be funded via usually Class 3 voluntary contributions, but certain conditions may apply to that. So again, it's always worth finding that out, and how you can do that is by obtaining a pension forecast. And I've put the website there for you to visit if indeed you haven't done so. It's very, very good in the sense that it gives you an indication of how many years qualifying national insurance contributions you've amassed, but it gives you the figure. So I think anyone who, arguably perhaps not as important as somebody in their sort of 30s or even early 40s, but certainly late 40s into the 50s, I would suggest everyone looks at that because it is very important. Next slide, please. Okay, so what do we do? What do we need to do from a pension point of view? Well, we need to make a plan. I would suggest everyone makes a plan. And I have what, when, how much. Okay, so what means really, well, what does retirement look like? When you think about retirement, what does it look like? Is it plenty of traveling? Is it spending more time with the family, wherever they may be? Is it spending more time on hobbies? Or is it just chilling and doing not much at all? But really, what does it look like? And then when is that likely to be? Has planning taken place to achieve that when? As I mentioned earlier, the earliest you can retire at the moment is 55 years of age. And more people are actually retiring earlier. However, what they're doing, they're almost semi-retiring. So they're drawing down on pensions, if they have flexible pensions, that is, and still maybe just reducing their hours 2 or 3 days a week. But having that target date is really important when it comes to pension funding, because you have and I appreciate it's not set in stone, but it's still a goal. So if your goal is to retire at the age of 60, make sure the funding is appropriate, given certain assumptions. I appreciate that, to ensure, or at least try to ensure, that the pension produces what hopefully you'd like it to produce as an income. And then, of course, we talk about income. Well, how much income does an individual need? Well, that varies, of course. It depends on appetite for spending, lifestyle, debt levels. Hopefully, once you're retired, the debt levels will be very low, or indeed non-existent, which would be great. So it's making that plan and understanding what retirement looks like, when are you going to retire, how much do you need to retire on. And I refer you back to, I think it was slide 3, where we looked at the different sources of income. And of course, as I mentioned earlier, it doesn't have to be a pension, of course, alone. But for most people, it is a pension. So think about it. If you have your own IFA, please speak to them. Make sure that they're doing what they should be doing for you. Next slide, please. So to sort of summarize, let's look at some considerations. I mean, some of these should be immediate considerations, but increase current pension contributions. You mentioned earlier that we each have an annual allowance of up to £40,000 to reduce taxable profits and increase retirement income. And again, I mentioned earlier, it is the most tax efficient method of saving money and extracting cash from your company into your own name. Now, if you don't hold a personal pension, particularly if you're a business owner, that's probably the only pension it will be, or a SIP, then think about setting a new plan up. You can set them up yourself online very cheaply. You won't receive regulated financial advice, or if you do, you'll be charged for it. But that's not a bad thing, because there are numerous investment funds out there. You need to make sure you pick the right one for you. Or indeed, speak to your own IFA, and you'll have my contact details, but feel free to drop me an email or give me a call. I'm more than happy to have an initial chat, at no charge, of course, to see if I can help. Use other savings to top up your retirement, such as ISAs, investments, premium bonds, inheritances, cash. Obtain that state pension forecast. I appreciate maybe it may not be as important to some people if they have huge assets. However, for the majority of people, it will be. And review your current pension arrangements on at least an annual basis. Far too many people don't review their pensions. They don't review their performance. They don't review whether or not that pension fund is still aligned to their current tolerance to risk, and indeed their charges. So it's important that pensions are reviewed, and certainly within 5 or 10 years, ensure have a look where they're invested. You may want to take less investment risk the closer you are to drawing your pension pot, because then you could possibly consolidate any gains you've made. And don't forget, if you're making personal contributions, this doesn't include employer contributions. I'm talking personal contributions, and you're a high rate taxpayer, which for the majority of people will be pay as you earn. Ensure you claim any high rate tax relief via your self-assessment. HMRC keep hundreds of millions of pounds in their coffers because people haven't claimed high rate tax relief via their self-assessment. So it's really important, if you're paying high rate tax, to make sure you claim that high rate tax back. And that includes employer pension schemes as well, by the way, if they're not net pay arrangement. Just there, the final bullet there on this particular screen, you'll see once you start drawing taxable income from a personal pension or a SIP, you'll be restricted to a maximum pension contribution of £4,000 a year. Now, that's really important if you've turned 55. Let's say you've got some old legacy pensions, maybe worth, I don't know, £20,000 or something like that. And you think, well, okay, I'll cash all of that in. I can suffer a bit of tax on that. It's not really going to produce much as an income. The problem with that, of course, is that once you access the pension and you take £1 of taxable income, then you are restricted to the maximum contribution of £4,000 a year into a pension. And this is relevant to everyone, really. So if you're, let's say, again, a limited company director, and you've had pensions in the past, I took a new client on who cashed in a Virgin pension in 2018. He cashed in £16,000. He runs a very successful company, and now he's restricted to £4,000 a year, including his employer contribution. His company, he can't pay any more in, and it frustrates him greatly. And the crazy thing was, he actually had an IFA at the time. He didn't warn him about this, but anyway. So it's important that. So don't forget that. Next slide, please. And that's me done. So as I mentioned earlier, speak to your IFAs. If you don't have a pension, set one up. Feel free to email me or contact me if you wish to have an initial chat. I'm more than happy to help. And thank you very much for listening.